Good evening, everybody. I'm very pleased to introduce my friend Vivek Astvansh, Assistant Professor of Marketing at the Kelley School of Business at Indiana University. Vivek joined Indiana University after receiving his PhD from the University of Western Ontario. I'm going to put a link to his bio in the chat box so that you can read more about his research and papers. But very broadly, Vivek seeks to understand how negative shocks in a firm's market environment, such as political threat, data breach, environmental regulations, product recall, and so on, can have an impact on a firm's marketing performance. Now, in marketing, we tend to pay a lot of lip service to interdisciplinary research and multi-method investigation, but there are very few academics who are bold enough to do either. Now, Vivek's research is truly interdisciplinary, with collaboration cutting across various management areas, and yet the findings of his research have a lot of relevance for the marketing function of firms. Today, Vivek will be presenting on the influence of geopolitical risk on corporate innovation. And if any of you have been investing in the stock market, you would have very recent experience of how international conflicts can have an immediate impact on firms, but there has been no inquiry of how these conflicts or geopolitical threats can impact corporate innovation. And this is what today's webinar is going to address. So I cordially invite Vivek to IMA's community to present his research. But before I hand it over to Vivek, let me say that you can unmute and ask questions at any point during this talk. You don't have to wait till the end to ask questions. But if you have any comments and not questions, please type it in the chat box so that others can also benefit from your comment. They can maybe add to the discussion, and we could possibly address it towards the end of the talk. In short, questions at any time during the talk, comments in the chat box. So thank you very much. And Vivek, over to you, please.
Thank you, Arun. You can easily be in the PR department. You are a true marketer. You've introduced me so well. I wish I could hire you as my PR guy. But thank you, Arun, and thank you to all the attendees who are attending this talk. I had job talked at IIM Ahmedabad in, I think, September of 2017. So that was my first interaction with the IMA faculty and students as well. And I remember at that point, during that visit, I taught machine learning to the doctoral students there. So fond memories. Thank you, folks. And as Arun mentioned, the benefit of a presentation is not in the presenter running through the slides. That would be too short-term oriented. The benefit is that it inspires you or gives you information that you did not know. And as a marketing professor, my marketing 101 is that whatever comes out of my mouth or from my slides should be novel. Otherwise, there is no contribution. So in that spirit, please unmute yourself if you have any comment or any question or observation to share, or please consider writing your comments in the chat window so that you all can interact with one another rather than this being a monologue. I'll share my screen and then I'll run through the slides. And also, don't worry about me taking more than 60 minutes. A hallmark of a presenter is that she or he should take only the time that has been assigned to her or him. So I'll take care of the time. I'll not go over 60 minutes, and I welcome more and more questions. Okay. Arun, can you give me a thumbs up if you see the screen? Thank you. About 2 hours ago, when I woke up, I saw this news on Reuters. Some of you might be aware that, I think many of you know that India and China have been adversaries for a very long time. But over the last few months, this adversarial relationship has spilled from geopolitics to businesses. Xiaomi happens to be one of the collateral damage business that is bearing the consequences of the conflict or tensions between India and China. And these conflicts are spilling over not only to businesses, but also to lay people, particularly the student community, that we all as professors and students or academics should be well aware of. You may have heard that when the pandemic started, China asked the Indian students who were studying in Chinese universities to go back to India. And the Indian federal government, the central government, has been working hard with the Chinese counterparts to open their universities to Indian nationals so that they can go back to their universities. But that hasn't happened, and there's a lot of tiff between the two countries, even in the non-business or academic front. So this is just a motivating example for what we are going to discuss today. The title of my paper that HBR published in March, and that I'm revising for marketing science, is Does Geopolitical Risk Stifle Technological Innovation? My co-authors on this paper are Wesley Deng, who is an assistant professor of finance at the University of New South Wales, Australia, and Adnan Habib, who is a PhD student in finance at the University of Tasmania, Australia. So you notice that there's a team of 3 people. One is a marketing professor and 2 are finance professors. Of the 3 co-authors, 2 are assistant professors and 1 is a doctoral student. And the beauty about this team is that I am from India, Wesley is from China, and Adnan is from Bangladesh. How beautiful. So a team of 3 Asians who are studying geopolitical risk, and the data are actually American. All right, folks. So the way I present my research is that I start with the findings, so that if any one of you has to leave, you at least have some takeaway in the first few minutes of the research. So I'll go through the list of findings, and then I'll spend the rest of the time telling you how I arrived at those findings so that you can critique my method and or the data. So the foremost finding is that global geopolitical risk decreases or stifles technological innovation output by American public companies. Now, what is geopolitical risk? And I'll come to the definition, but how do I measure geopolitical risk? So the measure is news-based. So we take 10 global newspapers, 6 from America, 3 from the United Kingdom, and 1 from Canada. And we identify the presence of geopolitical terms in the articles published in those newspapers. And with those geopolitical terms, there should be the word risk or uncertainty associated, so that the term is capturing geopolitical risk or geopolitical uncertainty. Okay, these data are not mine. These data are from an American Economic Review article that was published last month only. Now, how do I measure technological innovation? All right, a question. Yes, Adipta. Okay, I think someone unmuted by mistake. And what is technological innovation output? So technological innovation is just a fancy term for patents. So I'm measuring this technological innovation output in terms of the number of patents that a company files with the US Patent and Trademark Organization. The second measure is the financial value of these patents, which is basically in a year, as patents are granted by the USPTO to a firm, how much does the stock price increase or maybe decrease? I mean, you're not expected to decrease, but how much does it increase? Because that becomes a value that the stock investors are attributing to the granted patents. And my third measure is the scientific value of the patents, which is basically weighted forward citations that a patent receives. Okay, so 3 measures of technological innovation output: number of patents, financial value of patents, and scientific value of patents. So this finding basically says that as geopolitical risk increases, the technological innovation output of American public companies suppresses or decreases.
Yeah, just a small question. You said the patents are going down. That could have been a trend that the innovation is going down. I mean, can we also correlate it by the fact that in the last few years, a lot of US corporations have kind of bought the smaller companies, so who owns the patents? So do you think that there is a correlation? I mean, instead you go and innovate, you take over the smaller companies who have them, hence you don't file more. Do you think?
I agree with you. That's a good question. And I'm thinking, how do I account for that? I don't know whether and how I account for that, but that's a top question, my friend. I think a simple measure could be to control for the number of mergers and acquisitions that a focal company in my data set has had in the last few years. And maybe whether the acquisition or merger is in the same SIC code. But if I'll go back to my model and see if I don't control for this, I should do that. Thank you for asking.
Right.
So with this as the baseline result, what I next do is I take geopolitical risk and I decompose it into two components, geopolitical threat and geopolitical act. So act is basically what is happening right now between Ukraine and Russia. A threat is something that keeps happening between India and Pakistan, India and China, but the act happens once in a few times, like Pulwama or other actual acts that have happened. Now, the reason I decompose them into decompose geopolitical risk into threat and act is that threat is an unrealized risk. Someone is threatening you. You don't know whether this person will act on the threat or not, whereas act is realized risk. So there is a theoretical reason to decompose risk into realized risk versus unrealized risk. So I decompose my independent variable into its two components, and then I estimate the regression to find that the effect of threats on all the three dependent variables, number of patterns, financial value of patterns, and economic value of patterns, the effect of threats is greater than the effect of acts. Why do these effects exist? So I propose three mechanisms and I test them using different empirical methods. So the first mechanism I propose is that a firm's exposure to foreign markets, to customers in foreign markets, is the reason behind why geopolitical risk suppresses its innovation. That is, if you're a company, the more you draw your sales from foreign customers, the greater would be the impact of this geopolitical risk on your technological innovation output. How I measure this mechanism is by simple moderation or interaction effects. So I obtain, for every company, I obtain the proportion of the sales revenue that the company receives from foreign customers divided by the total sales revenue. So this measure gives me the exposure of this company toward foreign markets. And if my mechanism holds, then I would expect this interaction effect to have a stronger effect on innovation output. The second mechanism I propose is R&D investment. So the idea is, as global geopolitical risk increases, companies, or rather managers, will suppress or decrease their R&D intensity or R&D investment. And to the extent that R&D is a critical input required in technological innovation output, a decline in R&D investment would suppress the technological innovation output. So this I test using a classic mediation model. The third and the last mechanism I theorize is inventor turnover. So my idea is that as global geopolitical risk increases, more scientists and inventors or R&D staff members leave the company than the number that join the company. So this inventor turnover, so as geopolitical risk increases, inventor turnover increases. And as inventor turnover increases, the technological innovation output decreases, because you need employees, you need R&D scientists or inventors to produce patents. Then I next look at how long does this effect last, and depending upon the dependent variable you consider, the effect lasts between 3 to 5 years, which is substantial in terms of the longevity of the effect. These results that I report are robust to a bunch of things like instrumental variables regression. We control for other risks or uncertainty measures. The main results use news-based measure of geopolitical risk. I replace them with what is called geopolitical volatility, which is based on the concurrent movements of stock prices or stock market indices across the major stock exchanges in the world. The results are robust to excluding significant events. In the last few weeks, my co-authors and I have added a few other results. For example, right now, my focus was on technological innovation. We replaced that with any innovation. The innovation does not have to be necessarily technological. It could be non-technical as well. So we collected some more data on all the projects that are currently happening in a company, and we find out whether this R&D project is in the primitive or early stage or is it in advanced stage. So what we find is that as geopolitical risk increases, managers create new R&D projects. But because these are very new projects, the maturity of the product portfolio shifts towards early stage. And that is why the patents decrease and the scientific output decreases as well.
I have a couple of questions. Yes. So first of all, are you looking? So the way I understand you've operationalized the exposure to foreign markets is by looking at the sales revenue from other countries, from global markets. Now, what about outsourced innovation? What if have you accounted for innovation that is not happening in the country or some part of it is happening elsewhere, and the idea is borrowed domestically? And the second is, what about supply chains? So have you looked at whether there are, say, raw materials that are being procured from other countries, which might also, even if the markets are domestic and the production is domestic, but the raw materials might be coming from elsewhere? And could that be explaining the effect of threat and acts on innovation?
Thank you for asking those thoughtful questions, Arun. So you asked me two questions, but before I answer the two questions, I'll give you a clarification. You correctly understood the measure of exposure to foreign markets, but I have one more supplementary measure. So one measure is the sales revenue from foreign customers divided by the total sales revenue. The second measure is the number of foreign major customers divided by all major customers. Major in the United States is any customer that is giving you greater than or equal to 10% revenue, and the results hold. Now, answer to your first question. Your first question was, am I accounting for innovation that is outsourced? So I may have, so captive units, for example, Microsoft America has a captive unit in Microsoft India, which is filing the patent. The answer to that question is no, I don't account for that, because I don't know whether I can observe that variable, but I'll go back and see whether I can. It's a top question. The second question was, do I account for how the supply chain, what is the supply chain consequences? So if the geopolitical risk between India and China increasing, what does a Chinese company do if it is sourcing materials from India? Or more accurately, or more common occurrence is that an Indian company is sourcing raw materials from China. How does that happen? So I've tested that, and the effect is that when geopolitical risk increases, the company goes more inward focused. So it decreases the sourcing of raw materials from foreign countries, and it also decreases the sales to foreign countries. Now, what is very important is to know how I measure this. So what I do is I take the annual reports, and then I do this text search where I look at the presence of input output type words, and along with that, within plus minus 5 words, unigrams, I should be able to see input, output, sourcing, customer, export, import, those types of words. And again, these data are not mine. These data were released in a Journal of Finance paper. There is a gentleman called Jerry Hallberg in University of Southern California who has made these data available. Thank you, Arun. I think Tanmay has a question. Tanmay, next.
Yeah, Vivek, if we I'm trying to understand your mechanism. So this is simply, I mean, typically what you're saying whenever there is a trade collapse, but don't you think the impact or should not be the other side? I mean, the opposite. If there is a increase in threat in geopolitical risk, firms should invest more in R&D or should try to file more patent. So one possible mechanism probably you can check. These funders, they anticipate that the firms are having problems, so they are not simply giving enough funding to smooth their R&D expenditure. So it could be. So basically, it's the funders or the stock market. They anticipate these firms are having this problem, or they are not giving enough money. I don't know if it didn't make sense or not. Yeah.
So I'll paraphrase what I understood your question, Arun. You're saying that as threat increases, geopolitical threat increases, the more obvious mechanism should be that managers think, oh, we are under threat, we should increase our scientific output. And how do you do that? Spend more on R&D.
Yeah.
So what I am showing is counterintuitive. So the answer, Tanmay, is R&D is a discretionary spending. It is like me spending to buy a new white shirt. It's discretionary. Whenever you perceive threat from outside, the first thing to do is cut down on discretionary decisions and not increase R&D spending. So you are making a very thoughtful argument that firms should actually, okay, is there a threat outside? I'll beat this, I'll fight it out. What managers typically do is all discretionary spending decreases. R&D, advertising decrease, then managers start manipulating the earnings to leave the impression in the stock market that the company is doing well. There's a ton of literature that shows that any type of uncertainty or risk elicits a decrease in discretionary spending, such as R&D and advertising and XSG as well.
But Vivek, this is, I mean, yeah, the real earning managements were maybe might be different. But when these trades are long term, then probably, I mean, if these trades are short term, then managers might be thinking, so let's cut down this discretionary investment. It could be marketing or market expenditure, advertising expenditure, or R&D. But these trades, I assume these are very long term, right? This geopolitical risk. These are not going to solve. These are not short term. So it's a bit. I find it difficult to understand why managers would be cutting down R&D expenditure.
Yeah, but I see your point, but managers mostly are myopic. See, if you are a manager, remember when you and I took job interviews, my hiring manager will ask, where do you see yourself 5 years down the line? And I'll scratch my head and say, 5 years? I just want high salary. Talk about 1 year, 2 years. So managers are myopic or short-term oriented. Their career with this employer is short-term, 1 year, 2 years. They don't look at what would happen 5 years down the line. So they are driven more by their job prospects and value to their own career rather than, oh, let me make investments that will help the company in the long run. So that's what the research suggests as well. Alok, you had a question, my friend.
Yeah. So there are questions. The first is mechanism three, where you have mentioned inventory turnover and in bracket human capital. So why you have written like this? And the second is, have you checked differential impact of R&D vis-a-vis technological licensing? It means, let's say, one company who is doing R&D vis-a-vis another company who is dependent on technological licensing. Let me give one example. In India, HL manufactures Su-30, and Su-30 is basically technological product. I mean, license given by Russia. So if something happens, geopolitical threat, so the company who is dependent on technological licensing, so maybe for that particular company risk is higher vis-a-vis another company who is doing R&D. So have you checked differential impact between these two?
Thank you for asking, Alok. You asked me two questions. I'll answer them in the order. The first question was mechanism 3. Why am I considering inventor turnover? The answer is, my main result is that geopolitical risk decreases innovation output. Now, what do you need to produce patents? Two things at least. First is R&D spending. And R&D spending is basically spending money to hire more people, pay them more, buying more capital equipment, those types of expenses. The second is people. You may spend a lot of money, but if you don't have high quality people or human capital, you'll not be able to produce the output. So I'm considering our inventor turnover for this latter reason, that I need people who can produce the patents. Your second question was, I'm considering R&D investment. Did I compare the mechanism of R&D investment with the mechanism of technological licensing? Short answer, no, I did not. Longer answer is, I could do that, but I don't, off the top of my head, I don't know of a measure of technological licensing available. Typically, technological licensing is studied in the context of joint ventures or strategic alliances. You can use SDC Platinum data or other data sources where you observe that two companies have come together and one company is selling its technology to another company which can use it in the downstream market. I don't know of any readily available database that can help me test technological licensing. But more broadly, even if I had the data, what would be the incremental contribution? I think right now I'm considering the three mechanisms which are telling a coherent story. I can go into technological licensing and maybe other decisions that a firm takes if I have the data, but I'll go back and see whether I can collect these data. Thank you for asking. More questions, folks? Selva, you have a question.
Yeah. So how do you quantify the threat?
How do I quantify the threat? Oh, okay. I think you're talking. Oh, okay. So if you can give me a few more minutes, I'll tell you how the geopolitical risk is divided into acts versus threats. What are the terms that we look in news articles? So there's a dictionary that these people used, and they look at geopolitical terms, and close to that, they have the words for threat versus acts. And I'll give you a preview of those terms in a while. Okay, I think there is sunlight coming on my face. Let me shift my chair a little bit. All right, folks. Any other question?
And with respect to technology, right? So what are all the technology are you focusing? So the technology is a common word. Like what are all the technologies like you are focusing on your study?
All technology, so all patterns. I'm not focused on a specific technology. But what I also do in another supplementary analysis, I look at the patterns and I identify the fast changing technologies such as artificial intelligence, machine learning, deep learning, virtual reality, augmented reality. These are technologies that have far reaching implications and consequences in a variety of applications. So I call that the domain of patterns. And what I find is, as the geopolitical risk increases, the patents that companies file, they become narrower in their technological domains. So instead of creating a patent in an area that can be deployed in a broad range of applications, companies become myopic and they come up with patents which combine knowledge from a few limited fields, and thus their applications are going to be narrower. All right, I will continue. I'll keep a tab on the time. Okay, so this is the example I was telling you earlier, that the spillover of geopolitics is not only in the trade or even business, but there is an implication even for academics here. Now, some closer to the US, I'll give you some motivating examples of how this has played out between America and China. So in May 2019, the ex-president Donald Trump signed an order where he prevented Huawei from selling stuff in the United States. Interestingly, the day he signed this order, the journalists in America criticized him for taking decisions that are going to hurt the American technology companies. In July 2019, he partially lifted this ban. So you see, in May, he imposed the ban. In July, he partially lifted the ban. And in October, he reimposed the ban on Huawei. So just like Xiaomi has become sandwiched between India and China, Huawei has become sandwiched between America and China. Now, these geopolitical risks are not a function of the president or the prime minister. So they have little to do with Trump or with Xi Jinping or with Narendra Modi. They transcend presidencies. For example, right now, Joe Biden has been criticized for having a trade policy which is unclear. Elsewhere, we see tensions between US and Russia. Obviously, right now, we see tensions between Israel and Palestine, between Taiwan and China as well. Then you may have heard about China's endeavor, which has been going on for several years, which is called a 16+1, and some journalists call it a way to divide Europe. So basically what China is doing is it is increasing its business with the Eastern European countries by building what is called a Silk Route, and there are multiple names that are given to this. So this map indicates to you how this route is actually going from China all the way towards Eastern Europe and coming back to China. Now comes the definition of geopolitical risk. It is a threat, realization, and escalation of adverse events associated with wars, terrorism, and any tensions between and among states and regions that affect the peaceful course of international relations. So geopolitical risk is what interested me. And because I'm a business academic, my starting question was, does geopolitical risk affect corporate performance? If yes, what exactly should be my dependent variable? I read the news articles and the academic articles to understand what exactly should be the DV. And most of these articles that I read suggested that this geopolitical risk right now, or the geopolitical tensions, are to capture the innovation that the businesses are producing. And that led me to this research question, that does GPR stifle technological innovation? So the dependent variable now got closed into corporate tech innovation. There's some research that finance academics have done, and they have shown that whenever there's an exogenous shock, which could be a takeover shock or it could be a governance shock, they decrease technological innovation. So I'm building on academic literature, predominantly in finance, which shows that risks or uncertainty from the external environment decreases firm innovation. My contribution is in changing those risk-independent variables from economic uncertainty or a takeover risk to geopolitical risk. Now, this is the article that I was. This is the American Economic Review article that has provided me the data for geopolitical risk. And I think I have a slide where I'll show you how geopolitical risk has evolved with respect to India. So these economists, they basically sampled 10 newspapers, 6 in the United States: Chicago Tribune, LA Times, New York Times, USA Today, Wall Street Journal, and Washington Post; 3 in the United Kingdom, Daily Telegraph, Financial Times, and Guardian; and 1 in Canada, Globe and Mail. So their argument was that these 10 newspapers are global in nature, and thus they sampled these 10 newspapers. And then for each article published in each of these 10 newspapers since the year, I think 1985 is for these 10 newspapers, they classified each article on, does it have at least one term on geopolitical risk? And then for each month, they counted the total number of articles that were published in these 10 newspapers and the total number of articles that had at least one geopolitical term. So what they basically obtained is a ratio variable or a proportion, say 0.14. So 0.14 would mean that 14% of all the articles published in the focal month in these 10 newspapers had at least one term on geopolitical risk. Any question on how the independent variable is measured? Okay, and this is, I think, Selva's question. So Selva, you see, what they did was, they did this first, is they came up with the geopolitical risk measure, and then they identified 8 topics or themes or ideas: war threats, peace threats, military buildup, nuclear threats, and so on. And there are, if you go to their American Economic Review article, they've specified the terms that they searched for, say, military buildup. Okay, so this is what was happening in January of this year when Russia was building up or preparing itself to invade Ukraine. And then they have unrealized risk. So the first 5 topics or themes give us the measure of geopolitical threat, and the last 3 topics give us a measure of geopolitical act. And this is the
Silva here. What about the coronavirus, the pandemic, and that it will not come under threat?
Why will pandemic come under threat? So what is under threat is if the article is mentioning that the Wuhan virus or the COVID-19 virus was a geopolitical warfare. So if you view the pandemic as China's attempt to screw up the world, then it would be a geopolitical risk. But if, like most of us, see the pandemic as something that just happened to us, it's not something that China or any other country intentionally did, then it is not a geopolitical term.
Okay.
So I took the data from this American Economic Review article and I have plotted from 2015 month 1 until March of 2022, how the geopolitical risk in India has changed. So I know some of you may have interest in how the country has done over the last 8 years or so under Narendra Modi's government. So if you just ballpoint this data, you'll see how from 1 month to the other, the geopolitical risk has increased. And I see a clear line which is going up. Also, there are some months such as 2019 March, or if you see 2021 September, or even more recently 2022 February, when the geopolitical risk has increased a lot. You can relate it to what exactly happened between India and some other country that might have increased this geopolitical risk. And in most cases, you'll find that the tensions originate between India and China, or India and Pakistan. Now with the Ukraine-Russia war, India has become a more talked about country because India has taken a neutral stance rather than siding towards Ukraine and Russia. So these are my 3 dependent variables, folks: the number of patents, financial value of patents, and the scientific value of patents. If any one of you is interested in knowing what exact data file I use, what variable I use, what code I wrote, please send me an email. I'll send you the paper. In my paper, I mentioned the absolute details: the file name, the variable name, the data transformation I did. So I'll be happy. So some of the links are in the slides as well, but I'm happy to email you the paper should you be interested in knowing the details. And I constrain myself to US publicly listed companies from 1985 to 2017. Overall, I have close to 50,000 firm year observations covering 4,625 US firms. The unit of analysis is firm year. And this is basically the simple linear regression that I run, where my dependent variable is innovation by firm I in year T+1. And my independent variable is xit, which is where x could be the natural log transformation of geopolitical risk, geopolitical threat, or geopolitical act. Then I have a bunch of control variables and firm fixed effects as well.
Vivek, is it where when the patents are granted or when they apply?
Applied, filed, basically, because that will be the accurate measure of how much is the output. Because granting may takes a long time, but for financial value, I look at the granting, because that is when the stock market moves, when the USPTO grants a patent.
Vivek, is there any association between the occurrence of threats and risk at any given time? Because as the geopolitical risk, the acts of war go up, the threats also increase. Isn't there a simultaneous impact of these two, or do you think these two operate separately?
Top question, Arun. The correlation between these two is 0.3. So what I do in this linear regression, I first the first regression I run has x is equal to GPR, risk, and then I break down GPR into its 2 components. And I estimate a regression where I consider geopolitical threat, then a separate regression where I consider geopolitical act. This regression does not control for geopolitical act. Okay, otherwise then it becomes a correlated problem. Okay. But even the correlation was 0.3. It's not as high as we would expect. And to me, 0.3 is between low and moderate rather than be high as I would have expected. And this is the list of control variables that we include. As you see, all of these are either accounting variables or financial variables. I gave you a preview of the results. Let's dive a bit deeper into them. So focus on the red box. The interpretation is as geopolitical risk increases by 1%. So by the way, if you notice, my dependent variable is natural log transformed and my independent variable is natural log transformed, which means that my betas or the estimated coefficients could be interpreted as elasticities. So what is negative 0.177? It means that as geopolitical risk increases by 1%, the number of patents that a company submits or files with the USPTO in a year, on average, decreases by 1.77%. Similarly, as geopolitical risk increases, the financial value of the patents that the US PTO, Patent and Trademark Organization, grants to the company also decreases, and the scientific value also decreases, which means that others are less likely to cite your patent. Its scientific value is lower. And this is what Arun was mentioning. So I may now took the GPR and split it into its two components, GPT and GPA. Now, all these betas are negative. However, the insight is in comparing the magnitude. So look at the effect of threat on number of patents. The beta is negative 0.174. Now look at the same beta for geopolitical act. The value is negative 0.054. Now, regardless of which of the three dependent variables you consider, you will see that the effect of threat is greater than the effect of act, which to me is a novel theoretical insight. It means that unrealized risk, which is the threat, is more impactful than realized risk, which is the act. Now I go into testing my mechanisms. So my first mechanism was, yeah, on average, it's geopolitical risk decreases innovation, but it decreases innovation because a company can have exposure to foreign customers or foreign markets. Now I test this mechanism using interaction effects or moderation as opposed to mediation. So what I do is I hope I have I collect the data from CompuStat segments. And these are my two measures that I had mentioned to Arun earlier. So the first measure is both are ratio variables. In the first measure, the denominator is the number of all major customers and the numerator is number of foreign major customers. Okay, so it's a count. Then measure 2 is the denominator is the sales revenue from all major customers and the numerator is the sales revenue from foreign major customers. And major in the US is defined as any customer from whom you receive greater than or equal to 10% revenue. And the law in the US requires a company to disclose the name of this customer, major customers, and the dollars that the company has received from the customer and where is this customer located. Okay. So I estimated a regression, and just to keep the slide simple, I'm not showing you all the other rows of the results. What I find is that foreign customer has a negative effect on the number of patents and the scientific value of the patents, but it has a negative but insignificant effect on the economic or financial value of the patents. Okay, so I basically am able to observe my hypothesized effects on two of my three dependent variables. And the same pattern when I consider sales measure, the measure number 2. All right, mechanisms 2 and 3.
Can you explain that? Can you explain that finding again? The non-significant part about financial value. What explains that?
So it basically means that when the geopolitical risk increases. So what was my main finding in the second model? As geopolitical risk increases, stock investors would decrease their reward for the patents that the US PTO is granting you. Now, the stock investors don't care much about how much is your dependence or sales revenue that you are receiving from foreign customers. So the interaction effect, negative 0.136, it is negative, but it is statistically insignificant. So and my argument is that stock investors have already factored into have already considered your sales revenue from foreign customers. But as geopolitical risk increases, their reward or the penalty does not change by the proportion of your sales revenue from foreign customers. Okay, however, in contrast, if you have, look at number 1, number of patents, the interaction effect is negative 8.805. So if I am a company and geopolitical risk increases, my number of patents goes down. However, if I have high dependence or higher proportion of sales revenue from foreign customers, the effect is even more severe. Sorry.
But doesn't that go against conventional wisdom and evidence? Because stock markets, financial markets are very sensitive to geopolitical risk. So I don't understand the argument when you say that they don't mind the revenue coming from foreign sources when they are valuing innovation.
So I agree with you that the common sense is that when risk increases, suppose I'm a company, geopolitical risk increases, stock investors have to give me reward for the USPTO granting me a tenure. Not tenure, I'm sorry, granting me a patent. That's what happens when you become an academic. You start thinking in terms of tenure. However, if the risk is higher, the reward is lower. That's what the negative 0.216 indicates. Now, my a priori hypothesis, Arun, was that if I'm more dependent on foreign customers, they would penalize me, because now my cash flows are going to be further decrease further because of the high risk. But the data and the model suggest that such is not the case. But my hypothesis in the paper is that they would penalize me more. So I expected a significant and negative effect. But across both these measures, this one and the previous, I find that the penalty is not statistically significant. Okay. My next two mechanisms, just to remind you, was that mechanism 2 is that when geopolitical risk increases, managers decrease their R&D investment, which then hurts the patents. Mechanism 3 was as risk increases, more inventors and scientists and R&D staff members leave the company than they join. And this inventor turnover decreases innovation output. With R&D investment, I measure it as XRD by AT. XRD is the R&D expenses and AT is total assets, compute-stack variables. And I find, so look at the mediation model. For those of you who are experimenters or psychologists, they would perhaps find this useful, that as geopolitical risk increases, R&D investment has a negative effect. So negative 1.376 is the beta, and decrease in R&D decreases the number of patents. Alok?
Yeah, so here you are arguing that when this risk increases, then maybe R&D investment is coming down. But we can also argue that, let's say, if risk is increasing, then maybe country will invest more. I mean, firms will invest more in R&D to become self-independent. So, in fact, R&D investment should increase in some of the cases.
So I think this is similar to what Tanmay was arguing earlier. But I would counter that R&D it's a risky investment. So there is a ton of literature in marketing and other disciplines which shows that as company increases its R&D investment, the risk increases, idiosyncratic risk and systematic risk, or even its credit ratings. The problem with R&D is that it is an investment, and stock investors and even managers do not know whether these investments will pay off. So the overwhelming evidence is that because R&D is a discretionary and uncertain investment, when external risk increases, managers decrease their R&D spending.
Okay.
So, I mean, I think the intuition is, suppose I'm working for an Indian corporation and I see that there are layoffs happening elsewhere. So when there is an exogenous shock or uncertainty outside, am I less likely or more likely to go for a vacation and reboot myself? Because vacation, holidays are discretionary spending. It has long-term benefits for me, but uncertainty is there. So I'm less likely to spend on discretionary. I'll not even go for malls and exotic vacations. So I think that is the intuition, the way I see it.
So in innovation, you have considered both process innovation as well as product innovation?
Yes, all, even business model as well. So product, package, process, business model, all types. Next, I collected the data on inventor mobility or inventor turnover. So again, this Harvard Dataverse provides me the details for each patent. I observe the details of the scientist or the employee, and then I'm able to track whether the person has left or not left the organization. So the data are not perfect, the measure is not perfect, but that's the best alternative that we have right now. And again, what I find is that inventor turnover indeed explains is the underlying mechanism which explains why GPR suppresses or stifles technological innovation. Now, here is the interesting, what I find more interesting. So I have tested two mechanisms using mediation model. Which of these explains the effect more? Now, if I consider the volume of patents as my dependent variable, R&D investment explains 1.78% of the total effect, whereas inventor turnover explains 17.19% of the total effect. What is the insight? So R&D investment is a managerial choice. It's a managerial discretionary investment, whereas inventor turnover is human capital. It is something which is more relevant to human resources. Now, if you compare these two numbers, the insight is that human capital or inventor turnover explains 10% of the effect relative to managerial discretionary investment. So human capital is far more important, right? Which means that the implications is more for human resource or HR managers than product managers or R&D managers. So when geopolitical risk increases, managers should be careful of their R&D scientists and inventors and watch out for those people leaving the organization, as opposed to worrying about the R&D investment. If you consider the financial value of patents, which is my second dependent variable, R&D investment explains 2.35%, whereas inventor turnover explains 6.55% of that effect. Lastly, if you consider scientific value of patents, which is the forward citations, we find that R&D investment explains 2.75% of the total effect, whereas inventor turnover explains 9.2%. So regardless of which dependent variable you consider, the insight is that human capital explains the effect far more than managerial discretion. Any questions, folks?
Yeah, so Vivek, I have one. So just to continue my previous point, what I said, so your explanation, is the demand for R&D, right? On the demand side. So whenever there is a shock, managers are demanding less R&D investment. But don't you think a similar story can be built on the supply side? So there is a shock, stock markets, there is a less liquidity. So basically you don't have enough money to invest. Similarly, again, your human capital channel or mechanism is from the supply side, right? So supply of talent, basically, there is an outflow of talent from the firm, but it could also be a demand side, right? Firms don't have enough money to pay the managerial talent.
No, my friend. So in the latter regression, I control for R&D spending. And I control for labor productivity as well, which is labor productivity sale divided by EMP variable. So when I'm testing whether human capital is the underlying mechanism, I control for the R&D spending and the labor productivity. Had I not been controlling, then your critique would have been correct, Tanmay. Make sense, my friend? And on your supply side, if you're considering supply chain, that's a top question. And I have some results in this paper, but I'm wondering whether I can take off those results and write a new paper, which basically shows whether geopolitical risk affects the supply chain decisions.
But can you simply look at the wages? I mean, how much they are paying now? So if they are now paying less, or I don't know, some sort of that. Then you may think that it's not basically the demand side, but it's not basically the supply side, or you can just simply negate the one side.
So two answers to that. So again, a top question. First is the best measure of wages is XSGA.
Yeah.
Or XRD, depending upon whether the company puts the wages in R&D spending or selling general and administrative expenses. I control for that, but you are correct. It's a very aggregate measure. I cannot observe the wages that the company is paying to individual employees. However, the second point is I have the data on every company every year. I know the salary gap between the rank and file employees and the management employees. I also observe the wage gap between men and women. So a very novel and I think a useful question to ask is independent variable geopolitical risk, dependent variable is wage gap. So as the risk increases, do companies increase the wage gap such that they might be paying more to managers and paying less to rank and file employees, or does this shrink? You can ask the same question for men versus women. I mean, we are living in times of DEI, diversity, equity, and inclusion. So when risk increases in some external environment, do companies become, do they decrease the pay disparity between men and women, or do they increase it? So that's a very top question to study. And you could tie that not only with geopolitical risk, but also with political risk. And I study political risk as well, and I study diversity as well. That could be a novel question to ask.
No, I can understand. I mean, any general equilibrium effect is difficult to capture empirically. That I totally understand.
Vivek, I had a question here. So I'm sure this question has been answered in your paper. But then I'd like you to explain how you justify that it's not the reduction in the volume of patents that's leading to inventors to leave because they don't see much happening in the firm, and not the other way around. So what you're saying right now is that inventor turnover is leading to all of the results you find, but it could just be the case that geopolitical risk is leading to lower innovation. And then innovators think there's not much happening in this firm. Why should I stay? So I'll just leave. So it could be endogenous.
So your top question, Arun, your question is that of reverse causality.
Yes.
Right now, I'm saying geopolitical risk increases, people leave, and patents decline. You are saying actually what's happening, Vivek, is geopolitical risk increases, patents decrease, and people leave. So two ways by which I answer this. So the typical way to address reverse causality is that your dependent variable is in the next period. Now, it's not the best way, but it is how people use academics. That is a state of science. The second is reverse causality is just another form of omitted variable bias, and it leads to endogeneity. So to the extent that I can correct for the endogeneity of these variables, I am sort of addressing that. And I do that in the paper.
Vivek, there is a suggestion. I mean, you can think about it. There is a gap between when a patent is filed and when it is granted. So that period is really uncertain, for managerial talents in the firm. So they don't know whether it will be granted or not. So in some sense, whether you can exploit that, I don't know, probably.
So I agree. But Arun's question was that employees care about filing of patents. In most cases, the patents could be granted, and the granting may happen 5 years down the line, and employees may have forgotten. They care more about, are we filing patents? Are we filing patents? Because their name might go on the patent, and that is equity, or that is capital for them that they might be able to trade in the labor market. If they see that the company is not filing enough patents, they might realize that, I'm not growing in this company, I'm going to leave this company. So from that perspective, Arun's question holds there. I next plotted basically that I ran separate regressions where instead of looking at my dependent variable in t+1, I went to t+2 all the way until t+6, and I find that the effects that Hi Priya, consider muting your phone or
I'm unable to mute you. Yeah.
Okay, so then I find that these effects last for 3 to 5 years. I correct for endogeneity. So mostly you will say that this geopolitical risk is an exogenous shock. It's not something that the company has decided. However, there is an omitted variable called endogeneity. So I address this by using as instrument the religious tensions at the country level. So again, this ICRT provides a data set where they measure the religious tensions at the country level. So I use that as my instrument to instrument geopolitical risk, and the results hold. Then another critique of these findings could be that I'm not controlling for other forms of uncertainty and volatility at risk. So I control for macroeconomic uncertainty and stock market volatility, and the results hold. So geopolitical risk basically is available at monthly level, as I showed you. But my unit of analysis is for year. So what I do is I take the mean geopolitical risk in a year. I check the robustness using median, results hold. Then I used, instead of news-based geopolitical risk index, I consider global stock market-based measure, results hold. I excluded some significant events such as US bombing of Libya, Kuwait invasion, Gulf War, all those things that America did in the past, the 9/11 attack that was externally that happened on the US, Iraq war, and so on. And then I find that the results hold. The implications are for innovation research broadly. Now, I'll tell you what I'm doing right now. So first, I'm trying to do some prediction by using machine learning models where I take the standard predictors of innovation and I'm adding this geopolitical risk and political risk, and I'm trying to see how much my model becomes more accurate. I'm also, I'm not yet considered in these models, what can managers do to decrease or mitigate this adverse effect of geopolitical risk? So I'm considering mitigating actions such as advertising spending. There are other dependent variables that I could consider. Then another extension of this research is, instead of focusing on geopolitical risk, I'm considering political risk. You measure political risk at firm level from earnings call transcripts. Then you could explain heterogeneity based on corporate governance variables. And the last point is similar to what Arun was mentioning, that there could be reverse causality. However, the foremost reverse causality I'm considering here is that it's a tech innovation that is driving the geopolitics. That, for example, it is China's superiority or growing superiority in technology that is making America insecure, and that might be driving geopolitics. Similarly, if you consider Ukraine and Russia, was it only because of the Ukraine's possible entry into NATO, or was it because Ukraine had some raw materials or something else? But there are other reasons because of for this war. Thank you, folks. I think I am on time, 2 minutes late. I'm sorry. Just a reminder, if you have questions or comments, please don't hesitate to email me, and I'll be happy to send you my manuscript should you like to read that.
Just one. Can I ask one?
Yes, Swapnil?
Yeah, just one question. You established a very strong connection between the R&D and the patents. But we also know that the patent filing result to a lot of parallel R&D, especially patent gets filed by USA, and then parallel R&D starts at China, right? And we have also seen that from last 3 years when the COVID hit, the only last year, which is 2021, maybe, when the market has started, establishing itself again. So don't you think so? There is a predefined delay in patent call. Don't you think so? There is one more angle, because the moment they file patent, there is a parallel R&D that starts, and before they actually end up giving a product basis the patent, there is a parallel product which has already been announced.
So thoughtful questions, Swapnil. Honestly, I don't know the answer. Are you telling me that a company files patents with USPTO and the USPTO immediately makes this information publicly available? My guess was that this information stays hidden until the patent is decided upon, and if it is granted, then the patent becomes publicly available. And I understand that the intellectual property rights are weaker in other countries. So once a patent is granted to an American company, there's a possibility that a company in any other country, not just in China, could read the patent and then implement the patent and convert it into a product.
That's what I'm saying, because you said that data is very secure, it's very subjective, and at a very high corporate level, things get leaked because there are multiple people sitting at multiple boards. We don't know who's sitting at whose board. But my only point is that sometimes company intentionally don't file patent until the time they know that it is the actual need. And I also know the fact that there are companies who are ready with the innovative product, but they want to launch it in 2025, but not now, because they want to sell the current technology. I mean, what do you have to say about that?
So I agree with you. To the extent that that is correct, the measure is weak and the findings could be questioned. My response to that is, and I think I did have a slide on that, what I also measure is, for each company, I measured the number of new R&D projects that have been started. And I find is that, and then I measure the product portfolio and whether it is at a primitive stage or at an advanced stage. And I find that even if I take off the technological innovation part, the innovation decreases in the firm to the extent that that measure is correct again. But your question is very well taken, sir.
All right. So thank you, everyone. Thank you very much, Vivek. And I hope you get a chance to visit us and present here in person, hopefully soon. But the invitation is open. So thank you all for this very nice presentation, and have a great evening.
Thank you, Arun, and thank you everyone for asking all those questions. Should you be interested in doing some research in this area or just want to read my paper or the slides, please email me and I'll be happy to respond promptly. Thank you, everyone. Have a pleasant evening. Bye for now.